According to the World Bank, roughly 2.5 billion individuals worldwide are unbanked, existing almost entirely outside the formal financial system. Conventional interventions often prioritize basic banking access or introductory financial literacy. These are passive, one-way mechanisms that create awareness of services without providing a path for individuals to build and grow their own capital. This leaves millions standing outside an inaccessible financial system that is structurally designed to absorb and hoard capital rather than distribute it. By 2020, Malaysia's halal economy, an ecosystem spanning food, clothing, and travel, contributed about 7.5% to the national gross domestic product. This economic footprint highlights a different blueprint for financial inclusion: structural mechanisms that force capital to actively build and grow assets for marginalized demographics. Meaningful inclusion manifests as the continuous, systemic generation of new asset holders. Malaysia operates as a proving ground for this architecture, scaling alternative socio-economic models into national policy. The authority driving this ecosystem is Bank Negara Malaysia. The Central Bank of Malaysia Act 2009 mandates the promotion of a progressive and inclusive financial sector as a primary function of the state. Scaling these models requires a rigorous regulatory foundation. Bank Negara's frameworks, or consumer and investor protection, allow alternative financial systems to scale safely. We can map out exactly how this system integrates religious charity with modern capital markets through Malaysia's Islamic social finance architecture. This moves far beyond basic banking services. It offers a holistic, Sharia-compliant financial sector featuring complex capital markets and insurance products. A powerful central bank acts as the required catalyst, transforming unorganized religious charity into a highly regulated socio-economic engine. The base of this architecture rests on three core pillars: philanthropy, cooperative institutions, and microfinance. Within the philanthropy node, we find zakat. Because it relies on defined beneficiaries, this wealth tax is optimized for rapid disbursement and crisis response. Next to it is waqf, an endowment mechanism. Unlike zakat's immediate deployment, waqf locks in assets like real estate or capital to generate sustainable long-term surplus. Bank Negara Malaysia groups these tools under the regulatory umbrella of value-based intermediation, or VBI, ensuring all activities adhere to principles of economic justice. The United Nations Assistant Secretary General officially recognizes Islamic social finance as a beneficial framework for addressing global development needs. These ISF pillars function as institutionalized surplus-generating capital pools primed for market deployment. That capital deployment happens in the halal economy, a vast market spanning everything from food services to fashion and pharmaceuticals. Returning to our map, we place halal enterprises at the top. This is the destination for the foundational capital. To physically route the capital, the Halal Development Corporation built the Halal Industry Platform, or HIP, in 2021. 5 Islamic banks act as strategic partners here, plugging directly into the HIP to provide funding facilitation and business consultancy. This activates the pipeline. Capital generated by the social finance pillars flows through the partner banks directly into the operations of small and medium enterprises. Capital deployment results in expanded manufacturing capacity and immediate economic production. Structurally linking social finance to SME supply chains transforms charity into active socio-economic empowerment. Despite the system's success, Islamic finance accounts for a mere 4% of Malaysia's fintech landscape. This anomaly stems from a reliance on legacy architecture. Many institutions still manage complex capital through traditional analog desk counter services. On the architecture map, the system is breaking down right at the collection and distribution nodes for zakat and waqf. Analog ledgers lack the transparency and speed required to scale to modern consumer expectations. Without an immediate technological upgrade, this macroeconomic engine will choke on its own analog inefficiencies. The solution is a technological layer designed to digitize and secure every transaction across the foundation. We address the waqf bottleneck first. Blockchain technology replaces analog ledgers with decentralized, tamper-proof records. Migrating these critical asset records to a highly distributed ledger allows capital to move across the network without friction. This provides immutable transparency, securing asset management, and ensuring complete accountability among stakeholders. Next, mobile banking and digital wallets modernize the zakat collection process, aligning it with post-COVID consumer habits. Digital payment solutions allow for the rapid disbursement of funds directly to eligible beneficiaries without bureaucratic delay. Digital crowdfunding platforms serve as the final tool, allowing the broader community to easily fund new Waqf projects and initiatives. An upgraded system capitalizes on these new technological pathways to operate at full capacity. Fintech provides the essential structural scaffolding required to execute economic justice at scale. We now have the final, fully populated Islamic social finance architecture. It is a closed-loop cycle. Digitized collections feed robust institutions, which fund SME supply chains, driving GDP and societal wealth. This entire process remains stabilized by the oversight of Bank Negara Malaysia. Ultimately, the entire system operates as a highly efficient, self-sustaining mechanism, expressly designed for driving continuous momentum across the broader economy. Malaysia has transformed Islamic finance from a niche religious compliance standard into a competitive national financial infrastructure. True financial inclusion is achieved by designing an ecosystem where the underlying rules mandate shared prosperity and continuous asset generation.